Every time the economy collapses, you're told the same story. It was unpredictable, no one could have seen it coming, and everyone suffered equally. But here's the uncomfortable mystery. If economic crises are disasters, why do the same people always come out richer? Not just surviving, but expanding their wealth, power, and influence, while millions lose jobs, homes, and savings. This isn't luck. It's not coincidence. And it's not just being smart with money, because throughout modern history, from the Great Depression to the 2008 crash, from currency collapses to pandemic shutdowns, the pattern never changes. The public absorbs the pain, the system gets rescued, and a small financial elite quietly buys the wreckage. So tonight, we're asking a dangerous question. Are economic crises accidents or features? And if they're features, who designed them, how they work, and why they never seem to hurt the people at the top? To understand why crises reward the same people, we have to start with something uncomfortable. Modern economies are built on debt, not savings, not production, not gold or real assets. Debt. Governments borrow to spend, corporations borrow to grow, households borrow to survive. And at the center of this system sits a powerful structure most people never question: central banking and credit creation. Here's the part almost no one explains clearly. When a central bank lowers interest rates, it doesn't just stimulate the economy, it makes borrowing cheaper, which means those who already own assets can borrow more, faster, and at lower cost. Banks don't lend existing money, they create new money as debt. So the first people who receive newly created money, large banks, financial institutions, governments, and major corporations get to spend it before prices rise. This is called the Cantillon effect. And it's the first quiet mechanism that ensures inequality grows during every boom and explodes during every bust. Crises don't start randomly. They emerge after long periods of cheap money, rising leverage, and inflated asset prices. And the people closest to the money spigot see the danger long before everyone else. Let's go back to the early 20th century. Before modern central banking, financial crises were violent but short. Banks failed. Bad debt was wiped out. Credit contracted painfully, but decisively. Then came a new idea: crisis management. After repeated banking panics, governments and financiers concluded something radical. Crises were too destructive to be allowed to cleanse the system. So they created institutions designed to absorb losses, stabilize markets, and restore confidence. On paper, this sounded humane. In practice, it changed everything. Because once markets knew there was a safety net, risk-taking exploded, banks lent more aggressively, corporations took on more debt, speculators pushed asset prices higher, and when things broke, losses were no longer allowed to fall naturally, they were socialized. The first major test of this system came with the Great Depression. While millions starved and unemployment soared, certain investors quietly consolidated assets: land, factories, railroads, banks. Distressed prices became opportunity. The lesson learned by financial elites was simple and powerful. Crises are when ownership changes hands, and if you have liquidity during a collapse, you don't just survive, you dominate. Fast forward to the post-World War II era. The Bretton Woods system tied currencies to the dollar, and the dollar to gold. For a while, stability reigned, but by the 1970s, that restraint was gone. When money was no longer tied to anything real, debt could grow without limit, and grow it did. Financial markets expanded faster than real economies. Derivatives multiplied. Leverage became normalized. Crises didn't disappear, they became predictable cycles. The savings and loan crisis, the Asian financial crisis, the dot-com crash. Each time, governments and central banks responded the same way: lower rates, inject liquidity, rescue institutions deemed too big to fail. And each rescue carried an invisible transfer of wealth, because bailouts don't go to people, they go to balance sheets. While wages stagnated, asset prices recovered quickly, then surged higher than before. Who owns most assets? Not workers, not savers. The top 10% saw every rescue inflated wealth at the top while leaving debt behind for everyone else. Crises were no longer just failures, they became reset buttons, clearing competition, concentrating ownership, and reinforcing power. If there was ever a moment the illusion should have shattered, it was 2008. The global financial system nearly collapsed under the weight of reckless lending. Millions lost homes. Jobs vanished overnight. Entire countries entered austerity, and the cause was clear. Banks created massive amounts of bad debt, packaged it, sold it, insured it, and multiplied it through derivatives. When it failed, the response was immediate. Governments didn't ask whether banks deserved saving. They asked whether the system could survive without them. So trillions were created digitally, not earned, not taxed, created. Losses were absorbed. Executives kept bonuses. Shareholders were protected. Meanwhile, households were told to tighten their belts. This was the moment many people realized something unsettling. There is no free market during a crisis. There is intervention, but only in one direction. The system is designed to preserve institutions first, stability second, and people last. And from the ashes of 2008, the same pattern repeated. Markets crashed, then soared. Housing collapsed, then became unaffordable. Inequality widened faster than ever recorded. The same people didn't just recover, they expanded their lead. The aftermath of every crisis looks similar on the surface. Budget cuts, higher taxes, reduced public services. But underneath, something more permanent happens. Debt shifts. Private losses become public obligations. Government debt rises. Future generations inherit the bill. Meanwhile, asset owners benefit from rising prices fueled by stimulus. This creates a paradox. The worse the crisis, the stronger the justification for extraordinary measures. And extraordinary measures disproportionately benefit those already inside the financial system. Small businesses close. Large corporations consolidate. Families lose homes. Investment firms buy neighborhoods. Savings are eroded by inflation. Debt holders are paid back with cheaper money. By the time stability returns, the economic landscape has changed. Fewer competitors, more centralized power, greater dependence on debt. And the people who warned we must act to prevent collapse now own more of the economy than before. After every crisis, reforms are promised. New regulations, stronger oversight, safer systems. But reforms fade because the incentives never change. Financial institutions remain profitable. Governments remain dependent on borrowing. Central banks remain responsible for growth at all costs. Risk doesn't disappear, it just moves. Shadow banking replaces traditional banking. New financial products hide old dangers. Leverage returns quietly, and because markets believe intervention is guaranteed, discipline erodes. This is known as moral hazard, but it's rarely punished, because punishing it would require allowing failure at the top. And that's the one thing the system is designed to prevent. Look at recent years. Global shutdowns, massive stimulus, record money creation. While millions struggled, stock markets hit all-time highs. Wealth inequality surged at historic speed. Why? Because when central banks inject liquidity, it flows through financial channels first. By the time it reaches wages or prices, the advantage is already captured. This isn't corruption in the traditional sense. It's structural bias. The system rewards proximity to capital, not productivity, and crises accelerate this bias. They act like gravity, pulling wealth upward, not downward. 3 takeaways what this really means. So what should we take from all this? First takeaway. Economic crises are not equalizers. They are accelerators of existing inequality. Second takeaway. The people who get richer during crises aren't just lucky. They are positioned closer to money creation, credit access, and asset ownership. Third takeaway. As long as debt-driven systems rely on rescue over reset, crises will continue transferring wealth upward. Here's the uncomfortable thought to leave you with. If every crisis follows the same script, maybe the system isn't broken. Maybe it's working exactly as designed. The real question isn't when the next crisis will come, but who will be ready to buy when it does. If you want more deep dives into money, power, and the hidden mechanics of the global financial system, subscribe to the channel. Because the most dangerous thing in an economic crisis is not losing money. It's not understanding why you did.